Hello, everyone. My name is Anuradhan Gandula, and this is my presentation for financial management with Professor Oniapna. My topic for this presentation is going to be accounting in the headlines with a focus on Netflix original production. In this presentation, I'll explain how accounting principles have applied to Netflix film production process, particularly how production costs, revenues, and amortization are recorded in line with financial reporting standards. Yeah. Okay. So at first, let's talk about the entire scenario in that I'm going to be talking about. Netflix invests billions each year in creating original movies and shows to attract and retain subscribers worldwide. In doing so, the company must properly account for various financial transactions related to production, licensing, and amortization. These accounting activities ensure compliance with generally accepted accounting principles and international financial reporting standards. As noted by Hall, Bandyopadhyay, and Mowat in 2015, accurate financial reporting in the entertainment industry is crucial for reflecting both short term expenses and long term asset value. Uh, for the first transaction, we we're gonna assume that pays 5 million to a film production team to start developing an original movie. Let's call it, just for the sake of this example, Wednesday. The journal entry is debit production in progress, that'll be as an asset for $5 million, and credit cash asset for 5 million. This transaction follows the matching principle, which means costs are recorded when they are incurred to generate future revenues. According to Ariva in 2018, production costs are considered capital investments rather than immediate expenses because they create long term value through subscriber growth. For the second transaction, this would be for licensing revenue from partner platform. In this transaction, Netflix licenses streaming rights to another platform for $3 million for Wednesday. Now, let's call it 2B. The journal entry is the debit amounts receivable, that is asset for 3 million, and credit licensing revenue, uh, which would be revenue for $3 million. This follows the revenue recognition principle, where income is recorded once rights are transferred and the earning process is complete. As Hall stated in 2015, explaining that this ensures revenue are recognized and accurately and not prematurely, helping maintain transparency in financial reporting. Now, for the third amortization expense in this transaction, after the film is released, Netflix amortizes $1 million of production cost as an expense over time. Let's call it post production editing. The journal entry is debit amortization for $1 million and credit production in progress for $1 million. This step aligns with the expense recognition principle, matching the expense of content creation with the period it generates revenue for. As discussed by Ratnagaram, Chakravaram, and Tatikonda and Rao in 2020, amortizing production costs provides a more accurate reflection of profitability in the entertainment industry. Now, for my analysis of the entire situation, to summarize, Netflix accounting methods demonstrate how financial reporting supports strategic decisions by capitalizing production costs, recognizing licensing revenues, and applying amortization systematically. Netflix maintains compliance with general accounting principles and international financial reporting standards. These principles help ensure that company presents an accurate financial position and performance. As both Ariva and Hall emphasize, transparent accounting is essential for investor confidence and effective decision making in the media industry. These would be the references that I was referring to earlier in my presentation. Thank you and have a nice